When legendary investor Warren Buffett famously remarked that risk comes from not knowing what you are doing, he was addressing the critical difference between retail speculation and institutional risk management. Right now, behind the polished facade of mainstream financial reporting, a massive $1.5 trillion wall of commercial real estate debt is maturing into the highest interest rate environment seen in over 15 years. For over a decade, commercial property developers, private equity firms, and corporate real estate conglomerates gorged on near-zero interest rate loans, inflating property valuations to historic highs and building massive balance sheets backed by cheap, abundant credit. But as those multi-year loans mature and require refinancing at double or triple their original interest costs, the underlying math has collapsed. Office buildings, retail centers, and commercial hubs in major metropolitan areas across the United States are seeing structural vacancy rates rise, while their market valuations plunge by 30 to 50%. This is not merely a localized problem for property owners. It is a direct threat to the regional and community banks that hold the vast majority of these commercial mortgages on their books. Unlike major Wall Street institutions that have diversified balance sheets, regional banks in America carry a concentrated exposure to commercial real estate loans, representing hundreds of billions of dollars in potential defaults. When property values decline significantly below the outstanding loan balance, property owners face a logical economic decision: hand the keys back to the bank and default on the debt. This process of strategic default is already underway, leaving mid-sized banks holding illiquid, depreciated assets that cannot be sold without realizing massive balance sheet losses. As Dalio has repeatedly pointed out in his analysis of long-term debt cycles, when debt service costs outpace revenue growth and asset values decline simultaneously, a deleveraging event becomes unavoidable. The central bank finds itself in an impossible position. If it slashes interest rates to rescue the commercial real estate market and save regional lenders from insolvency, it risks reigniting persistent price inflation and destroying consumer confidence in the purchasing power of the currency. Conversely, if it keeps rates elevated to combat structural inflation, it accelerates the wave of defaults across the commercial property sector, triggering a severe credit contraction throughout the real economy. Institutional managers understand that when credit contracts, liquidity vanishes overnight, making cash availability and top-tier assets the ultimate survival tools. This is precisely why major financial players are systematically de-risking their portfolios, selling off paper claims, and accumulating hard assets with zero counterparty risk. The general public remains largely unaware of this developing maturity wall because financial institutions choose to extend and pretend, quietly modifying loan terms behind closed doors to delay realizing losses on their balance sheets. But extending a bad loan at unsustainable rates does not eliminate the underlying debt. It merely compounds the ultimate cost when the bill finally comes due. We are standing at the edge of a structural credit adjustment that will redefine the commercial banking landscape, and those who do not understand the mechanics of this debt wall are positioned to absorb the full force of the fallout. To fully grasp how this commercial real estate debt wall transforms into a wider economic contagion, one must look closely at the balance sheets of community and regional banks. Unlike global systemically important institutions that possess diverse revenue streams from investment banking, wealth management, and international currency trading, regional lenders rely heavily on commercial real estate mortgages as their primary income driver. In hundreds of American cities, local financial institutions hold balance sheets where commercial property loans account for up to 30 or 40% of their total asset base. When those properties lose 30 to 50% of their appraised value due to structural vacancy shifts and elevated borrowing costs, the underlying collateral securing those loans becomes deeply impaired. Under traditional accounting standards, as long as a loan is not formally in default, the bank is not required to mark the underlying asset to current market values. This accounting leeway creates a dangerous illusion of solvency, concealing the reality that hundreds of institutions are carrying massive unrealized losses. If a wave of property owners chooses to walk away from underwater assets, those losses must be recognized instantly, wiping out bank equity capital and pushing institutions toward regulatory insolvency. The legendary investor Warren Buffett has consistently warned that when leverage is combined with illiquid collateral, unexpected shocks inevitably expose fragile balance sheets. In the context of the current commercial real estate bottleneck, the contagion does not stop at the bank doors. It spills over into municipal budgets, pension funds, and local economies. Commercial properties represent a major source of property tax revenue for local municipalities. When office towers and retail centers suffer severe valuation write-downs, tax assessments drop accordingly, starving local governments of funding for public infrastructure, emergency services, and civic operations. Simultaneously, major public pension funds and institutional asset managers that allocated billions of dollars into private real estate funds over the past decade are now forced to write down their real estate holdings or restrict redemptions to prevent panic withdrawals. Ray Dalio's framework for deleveraging demonstrates that when an economy hits a debt wall, the choice narrows to two destructive paths. Either allow systemic liquidations and widespread credit defaults that crash the financial system, or force the monetary authority to step in and monetize the losses through currency debasement. When central banks choose to backstop failing real estate portfolios or create emergency lending facilities for regional banks, they are not creating new real wealth. They are diluting the purchasing power of existing money in circulation. This monetary expansion acts as a hidden tax on the middle class, pushing the cost of living higher while asset values remain artificially propped up. Sophisticated capital allocators recognize this cycle and are taking decisive action. Instead of relying on traditional real estate investment trusts or paper debt instruments, institutional insiders are shifting liquidity into tangible assets with zero default risk, positioning themselves to acquire distressed real estate assets at massive discounts only after the final wave of forced liquidations clears the market. The retail public, relying on delayed economic reporting and comforting media narratives, remains exposed to the fallout, holding cash in institutions that are fundamentally misaligned with the economic reality of the coming debt maturity wave. The true danger of the commercial real estate crisis lies not in the immediate defaults of property developers, but in the intricate web of shadow banking and derivative financial products that multiply those defaults throughout the international monetary network. Outside the traditional regulated commercial banking sector sits a multi-trillion-dollar shadow banking system composed of private credit funds, real estate debt funds, mortgage REITs, and specialized offshore vehicles that operate with minimal regulatory oversight and massive amounts of leverage. During the era of ultra-low interest rates, these non-bank financial intermediaries aggressively expanded their balance sheets by issuing collateralized loan obligations backed by commercial mortgages, packaging high-risk property debt into complex structured products, and selling them to institutional investors worldwide. Today, as property valuations plunge and tenants default on lease agreements, the underlying cash flows supporting these structured products are rapidly evaporating. When the underlying collateral degrades, it triggers automatic credit downgrades and margin calls across the shadow banking system, forcing fund managers to liquidate assets at fire sale prices to cover their borrowing costs. This dynamic mirrors the structural mechanics of the 2008 subprime mortgage crisis, but with a critical difference. This time, the rot is concentrated in commercial property balance sheets rather than residential mortgages, and the exposure is distributed across an opaque network of non-bank institutions where counterparty risk is nearly impossible to quantify. As Ray Dalio has documented in his extensive studies of historical deleveraging cycles, when financial systems become burdened by unpayable debt obligations wrapped in complex financial engineering, the resulting liquidity freeze spreads far beyond the original asset class. Major life insurance companies, sovereign wealth funds, and private equity conglomerates that invested heavily in commercial real estate debt to generate yield are now facing unprecedented paper losses that threaten their ability to meet long-term obligations. When these institutional giants are forced to freeze redemptions or sell liquid holdings like blue-chip equities and corporate bonds to raise cash, the commercial real estate problem directly spills over into mainstream equity and bond markets. Simultaneously, the Federal Reserve and international central banks find themselves trapped in a severe structural dilemma. If they step in to print money and buy up toxic commercial property debt, or provide emergency liquidity backstops to non-bank financial institutions, they directly accelerate the destruction of fiat currency purchasing power, driving persistent inflation and eroding public trust in national money. On the other hand, if they refuse to intervene and allow the market to clear through outright liquidations, the resulting wave of credit defaults will trigger a severe deflationary depression and a catastrophic contraction of the global money supply. As Warren Buffett has famously cautioned, leverage is the dangerous drug that turns temporary market dislocations into permanent financial ruin. Insiders who understand the structural limits of paper assets are not waiting for central bankers to solve this mathematical impossibility. They are systematically unwinding paper claims, exiting leveraged debt positions, and redirecting capital into unencumbered hard assets, essential physical infrastructure, productive farmland, and physical precious metals that carry zero counterparty risk and cannot be diluted through central bank money creation. The structural unwinding of the commercial debt wall is a mathematical certainty, and those who remain complacent in paper claims will bear the full burden of this historic wealth transfer. The structural contagion radiating from the commercial real estate sector is now intersecting with a far larger and more dangerous systemic vulnerability: the unprecedented refinancing pressure on sovereign national debt. Over the next 12 to 24 months, governments across the Western world must roll over trillions of dollars in maturing short-term sovereign bonds, while simultaneously issuing massive tranches of new debt to fund persistent structural budget deficits. In ordinary economic conditions, sovereign debt issuance is absorbed seamlessly by global central banks, commercial banking institutions, and foreign trade partners who recycle their net export surpluses back into sovereign paper. However, the present environment is anything but ordinary. Commercial banks, currently weighed down by hundreds of billions of dollars in unrealized losses from commercial mortgages and depreciated bond portfolios, no longer possess the capital flexibility or balance sheet capacity to absorb massive new tranches of government debt without severely contracting their commercial lending operations. At the exact same time, major foreign nations and foreign central banks are systematically reducing their holdings of sovereign paper, choosing instead to settle international trade in regional currencies or convert trade surpluses directly into physical gold bullion. This structural decline in global demand for sovereign debt leaves national treasuries with a catastrophic funding shortfall at the precise moment when debt service costs are accelerating at their fastest pace in modern history. As annual interest expenditures on national debt climb toward and surpass the budget allocations for critical national defense and major domestic infrastructure, the arithmetic reality of fiscal dominance takes total control of the economic landscape. Under fiscal dominance, traditional central bank monetary policy ceases to operate independently. Monetary decisions are forced to submit entirely to the fiscal survival needs of the state. When the volume of maturing debt and budget deficits exceeds the organic market demand for government bonds, the central bank is left with only two possible options, both of which lead to severe economic disruption. The first option is to allow free market price discovery, permitting government bond yields to spike to levels that reflect true credit risk and inflation risk. However, allowing yields to rise unabated rapidly destabilizes the banking sector, triggers immediate insolvencies among leveraged institutions holding long-duration assets, and forces the sovereign government into an explicit debt default as interest payments consume total tax revenues. The second option, which historical precedent proves governments always choose in late-stage debt cycles, is to initiate aggressive debt monetization, activating emergency liquidity facilities and printing vast quantities of currency to purchase unsold government paper directly. As the legendary investor Ray Dalio has repeatedly demonstrated in his historical analyses of monetary regimes, choosing debt monetization preserves the nominal solvency of the government and the banking sector, but it achieves this by systematically destroying the real purchasing power of the national currency. This process manifests as persistent, structural price inflation, eroding the real value of paper savings, fixed income pensions, and wage income across the entire population. Warren Buffett succinctly captured the essence of this monetary dynamic when he observed that relentless currency inflation acts as a silent, unlegislated tax that confiscates human labor and purchasing power without the need for public approval. Institutional insiders, sovereign wealth directors, and family offices are acutely aware that when a nation enters the terminal phase of fiscal dominance, holding paper claims, long-duration fixed-income bonds, or traditional commercial bank deposits is a guaranteed mechanism for real capital destruction. They recognize that in this environment, nominal market gains in stock indices are largely an illusion driven by currency debasement rather than true productivity expansion. Consequently, the world's most sophisticated capital allocators are executing a quiet, systematic exit from paper-based promises and concentrating liquidity into tangible hard assets, essential commodity producers, physical precious metals, and strategic real estate with low leverage. They understand that when the monetary architecture undergoes a forced structural reset, wealth is not destroyed. It is simply transferred from those who held paper promises to those who held real, unencumbered assets. As the systemic pressures of maturing commercial debt, banking sector fragility, and sovereign fiscal dominance converge, we are entering the final phase of a classic macro debt cycle reset. The mathematical reality of this financial bottleneck dictates that the current paradigm of paper asset expansion and unbacked credit growth has reached its structural limits. When debt levels exceed the productive capacity of the underlying economy, the traditional playbooks of asset allocation cease to function, and the rules of wealth preservation are completely rewritten. Investors who rely on outdated financial models and mainstream narratives will find themselves trapped in a prolonged environment of negative real returns, where nominal asset gains are rapidly consumed by persistent currency debasement and rising systemic costs. Ray Dalio's historical framework shows that during every major monetary transition over the past 500 years, capital consistently migrates away from paper claims, leveraged debt, and central bank liabilities toward unencumbered, physical hard assets that carry zero default risk and possess intrinsic value that cannot be diluted by policy decisions. The commercial real estate debt wall is not an isolated market dislocation. It is the catalyst exposing the fundamental vulnerability of a monetary system built entirely on compounding leverage. Warren Buffett's fundamental principle of investing has always centered on protecting capital above all else, identifying durable competitive moats, and avoiding situations where financial leverage creates catastrophic downside exposure. In this environment, the ultimate competitive moat is absolute balance sheet liquidity and ownership of tangible assets that generate real, essential value regardless of monetary conditions. As regional banks restrict commercial lending, as shadow banking entities face mandatory margin liquidations, and as central banks inevitably choose currency debasement over outright financial collapse, the distribution of global wealth will shift dramatically. Those who understand these institutional mechanics are already positioning their portfolios outside the vulnerable paper architecture, preparing to acquire distressed, high-quality real assets at generational discounts once the final wave of forced liquidations reaches its conclusion. Understanding these deep macroeconomic shifts, navigating structural debt cycles, and protecting your capital from currency debasement requires continuous, institutional-grade analysis before these trends hit mainstream headlines. If you find value in these deep macroeconomic breakdowns and want to stay ahead of the structural shifts transforming global markets, make sure to subscribe to the channel right now, turn on notification alerts, and join our growing community of strategic, macro-focused investors who prioritize true wealth preservation over short-term market noise. The coming years will reward those who act with clarity, discipline, and historical perspective, while leaving those who remain passive to absorb the full burden of this monetary transition. By mastering the fundamental laws of money, credit cycles, and hard asset allocation, you position yourself not merely to survive the unwinding of the global debt wall, but to capitalize on the greatest transfer of wealth in modern financial history. This structural reset is not a distant theoretical possibility. It is an active economic reality unfolding in real time across balance sheets, capital markets, and international monetary flows. When you look beyond the short-term fluctuations of daily market indices and analyze the underlying mechanics of debt maturities, central bank liquidity operations, and sovereign fiscal deficits, the path ahead becomes unmistakably clear. The era of cheap credit, artificial asset inflation, and risk-free paper returns has reached its definitive end, giving way to a volatile macro regime where discipline, deep fundamental research, and tangible asset ownership will dictate financial survival. The investors who succeed in this new paradigm will not be those who chase momentum or rely on traditional passive strategies, but those who possess the clarity to recognize structural shifts before they are fully priced into mainstream assets. By taking control of your financial knowledge, understanding the history of debt cycles, and taking decisive action to insulate your wealth from systemic counterparty risk, you transform a period of historical financial turbulence into an unprecedented strategic opportunity. The choices made during this decade will determine the trajectory of generational wealth, making it essential to remain vigilant, intellectually rigorous, and focused on real capital preservation as the global monetary landscape continues to evolve.